Accounting of fair value hedge. If the derivative is used to hedge an equity instrument which is measured at FVT OCI, change in fair value of derivative will be recognized in OCI. If the derivative is used to hedge a debt instrument measured at OCI, then the change in the fair value of debt instrument will be recognized in P&L account instead of OCI. If the derivative is used to hedge a debt instrument which is carried at amortized cost, then this amortized cost instrument's change in fair value will be recognized in P&L account and its effective interest rate will also be adjusted. If a derivative is used for hedging an unrecognized firm commitment, then change in the fair value of firm commitment and change in fair value of derivative both will be recognized in P&L account, and when the asset or the liability is recognized, the fair value of the firm commitment is adjusted against that asset or liability. So that is fair value hedge. Okay. The idea of fair value hedge accounting is that change in fair value of derivative and change in fair value of the hedged item should be recognized in P&L account in the same period or in the OCI in the same period. And one rough example just for understanding the concept. Suppose there is a hedged item. There is a hedged item and there is a derivative. In first year, a hedged item gain or loss is not there. It is in the second year, and on the derivative there is a gain of 10. Understand this diagram difficult for you to understand for first time reader. This is the gain on derivative, and the hedged item gain will be recognized in P&L account in the next year. Now if I do not apply hedge accounting, first year we will recognize profit and second year we will recognize loss. But what the hedge accounting does, it shifts the loss which you are supposed to recognize in the next year on this hedged item. Let's say it is an amortized cost instrument or a debt instrument measured at FVT OCI. Instead of going next year to P&L account, it is recognized in the P&L account in year 1 only. So what we have done, that 10 which was going to get recognized in year 2 comes in year 1. Now 10 loss, 10 gain, net effect 0. Year 2 also. This 10 I have already shifted here. So this is 0, this is 0, this is 0. Without hedge accounting, first year will show a gain of 10 crore. Second year will show a loss of 10 crore. With hedge accounting, first year will show 0 profit or loss. Second year will also show 0 profit or loss. That is the benefit. Only that arrow in your notes, you may have to just put it up in the first line. Now before we solve some questions which are based on interest rate swap, we'll first see what is the meaning of interest rate swap. Interest rate swap. Swap means exchange. To swap means to exchange. Is it right? So interest rate swap means we are exchanging our interest obligations. We are exchanging our interest obligation. So if I have to pay fixed rate of interest, but I want that I want to pay at floating rate of interest. So what will I do? One option is you redeem the old bond and issue a new bond at floating rate. But is it that simple and cost effective? No. Redeeming the old bond means you have to pay prepayment charges. Issuing a new bond means again you have to incur the flotation cost, brokerage, commission, legal expenses. All this together in today's world can cost you 4 to 8%. Is it right? Other way, keep the original debt instrument as it is. Enter into an interest rate swap arrangement where you can exchange your fixed rate obligation against floating rate obligation. You can exchange your fixed rate obligation against floating rate obligation. So you end up paying at floating rate and your fixed rate obligation is taken care of by other party. So you have effectively converted your fixed rate liability into a floating rate liability, or vice versa also. You have taken a floating rate loan and you are expecting interest rate will go up. It will cause you loss. What you should do? Either you redeem that old loan, again take fresh loan at fixed rate, simple technique, but that is a costly affair, time consuming affair. Okay, raising of fresh loan, redeeming of old loan has a cost involved, time involved, efforts involved. Whereas this is a simple trick. You can convert your floating rate obligation into fixed rate obligation by swapping your floating rate obligation against fixed rate obligation. So you find a counterparty and you say, I will meet your fixed rate obligation, you meet my floating rate obligation. And there are investment bankers who arrange for such deals. You will think, how do I find a party who will enter with such arrangement? So there are investment bankers, and in some markets even interest rate swaps are traded on the exchange. So you can convert your fixed rate obligation into floating rate and vice versa, and therefore you get a desired way of receiving or paying the interest. Okay, so that is called interest rate swap. Interest rate swap is a financial contract between two parties to exchange one series of cash flows, that is fixed interest. One party will pay fixed interest for another series of cash flow, that is variable or floating rate. The other party will pay variable or floating rate on an agreed amount called notional principal. In interest rate swap, principal amount is not exchanged, only the interest amount is exchanged. But for calculating interest, we have to take a notional principal amount. Interest calculation will require principal rate time. So both party will agree, oh, this is 50 crore rupees principal, on that will calculate interest. And this is done for an agreed period of time, maybe 3 years, 5 years, 1 year. Principal is not exchanged. And one more thing I need to tell you, they only exchange the difference. They only exchange the difference. They don't even exchange the gross interest. There's no point. I giving you 11,000 and you giving me 10,000. So what do? They only pay the difference, which is effectively the same. Is it right? So every period they will calculate how much amount is payable under fixed rate obligation, how much amount is payable under floating rate obligation. Fixed rate obligation will remain fixed only, no problem, but floating rate obligation may change every period as the underlying benchmark rate like LIBOR may change. So sometimes the fixed rate pair may gain, sometimes the floating rate pair may gain. So the winner will pay the difference to the loser. Okay, and we'll have to pass entry for only the net difference here. You have to pass entry only for net difference. Effect of interest rate swap arrangement is you are able to eliminate or avoid or reduce the interest rate risk. Okay, you can reduce your interest rate risk. Now one small diagram I have drawn for understanding purpose. This is a party A, party B. Party A borrows at fixed rate from the lender originally. Party B borrows at floating rate from the lender. But now party A wants to pay at floating rate and party B wants to pay at fixed rate. Is it right? Suppose the principal amount is same for both party, 100 crore rupees. So what party A will do? It will go to party B. Say, party B, I will pay you your floating rate and you pay my fixed rate. So they will calculate every period they will calculate the liability. Party A will pay to party B floating rate which they will pass on to their lender. Party B will pay fixed rate to party A which will pass on to the lender. So effectively through interest rate swap, what is the outflow of party A every period? Floating rate. Because your fixed rate obligation is taken care of by B. And party B is effectively paying fixed rate because your floating rate obligation is taken care of by party A. Two contracts will be entered here. Both parties will enter into two contracts. One, your original contract with your lender continues as it is, that is not disturbed. So I have taken a loan from Bank of India, example only. So that loan continues. And then I have entered into a interest rate swap also. This is another contract. With my banker, I will pay the gross interest amount, 100 crore into 10%. Example, 10 crore. But with other party, I will only receive or pay the difference between these two numbers. So effectively the result is that I convert my fixed rate into floating rate or floating rate into fixed rate. That is the net effect of this. So how much entry you will have to pass? One entry you have to pass for loan taken, usual entry. One entry you have to pass for interest paid to lender, again normal entry. And then one entry you have to pass for the net interest received or paid. 3 entries. One entry you have to pass for revaluation of gain or loss on this underlying instrument, fair value gain or loss on asset or liability, and one entry you have to pass for change in the fair value of interest rate swap. Interest rate swap is a derivative. Its fair value also changes as the market rate of interest will change. Okay, so these are the entries you will have to pass. In one small example, number 55, we are going to understand how the entries will be passed in case of interest rate swap. Question looks difficult from a distance, but it is simple. Entity A has originated a 5% fixed rate loan asset that is measured at amortized cost $1 lakh. Okay. So if you can understand the question, answer is very easy. This entity A has in its book a loan asset. So it's a financial asset. And how they are measuring it? At amortized cost. 1 lakh is the book value. 5% is the coupon rate. Because entity A is considering whether to securitize the loan asset, that is to sell it in a securitization transaction, it wants to eliminate the risk of change in fair value of the loan asset. Now next year they want to securitize it. We have seen the meaning of securitization. They want to sell it to another entity. But when are you going to securitize it? After some point of time. And what can happen? The fair value of this loan asset can change. Today it is $1 lakh, but it can go down and therefore they will suffer a loss. On 1st January 2006, entity A enters into a pay fixed and receive floating interest rate swap. Pay fixed, receive floating interest rate swap. Okay. To convert the fixed interest receipt into floating interest receipt. Now what is the original receivable in fixed rate? They have converted their fixed interest receivable into floating interest receivable and thereby offset the exposure to changes in fair value. So this is called interest rate swap. You will pay fixed rate and you will receive floating rate. So you have converted your fixed rate receipt into floating rate receipt. What is the strategy behind it? If the market rate of interest goes up, there will be loss in the value of the loan asset. Higher the market rate of interest, lower the value. But there will be a gain on this swap. You will pay at a fixed rate, but you will receive at a floating rate. So if the market rate of interest goes up, you will get more interest, not only for this period, for all the period. So therefore there will be a gain on this interest rate swap if the market rate of interest goes up, because you will receive floating rate, you will receive more. So the loss will be compensated by the gain on derivative. So they have written so nicely, thereby offset the exposure to changes in fair value. Entity A designates the swap as a hedging instrument in a fair value hedge of the loan asset. So they have decided to follow hedge accounting rules. And this hedge loan asset is designated as hedged item, swap as hedging instrument. And they have mentioned it is a fair value hedge. Even if it was not mentioned, it is a fair value hedge because the objective is to protect the value of this loan asset, which is right now $1 lakh. Market interest rate increase. Oh, so your expectation was right. At the end of the year, entity A receives $5,000 interest income on the loan. Now, dear student, how this 5,000 has come? 5% of 1 lakh. This is original contract with the original entity. We are investor. So the entity where we have invested will give you 5,000 interest income and $200 in the net interest payment on the swap. You will not be able to check how this $200 has come. They have given. It is the difference between fixed and floating rate. It is the difference between fixed and floating rate. Since the amount is given, pass entry for this amount. Had it not been given, then we have to calculate. So in one other problem, we will see the calculation of this difference also. Don't worry. Now this is interest received. Two interests you are receiving. One on the loan asset. Second, the differential interest on interest rate swap. So bank account debit, 2 times, to interest, 500 and 5,200. But there are underlying items also whose fair value is also changing. Now you see what in this standard says. This instrument is originally measured at amortized cost. Normally we would not have changed the fair value. Ignore the fair value change normally. But hedge accounting rule says no. If there is a change in fair value of instrument measured at amortized cost, change in fair value will be shown in profit and loss account. So today you will not ignore. Change in fair value of interest rate swap is an increase of 1300. Gain on derivative. Fair value of the loan asset decreases by 1300. Loss on loan asset, exactly 1300. So it seems the hedge is highly effective. The loss is compensated by the gain on derivative. What you have to do, just pass 4 journal entries at the end of the year. So end of the year, if you have to pass the entry, I don't have to pass entry for issue of loan. That has already been issued at the beginning only. Is it right? So pass 4 entries. First entry, pass entry for interest received on loan asset. Cash or bank account debit 5,000 to interest income 5,000, being interest income received on the loan. Then you receive 200 also. Cash or bank account debit to interest income 200 to record the net interest settlement on the swap. Written. Then pass entry for gain on derivative. There is a positive gain of 1300 on derivative. So you will write derivative account debit to hedging gain. And where this hedging gain will be transferred to, write in bracket penal account. Otherwise you have to pass one more entry to transfer. Do you want to do that? No. to record the increase in fair value of the swap. One more try. The loan asset fair value will decrease by 1300. So even though it was originally designated as amortized cost instrument, but because you are following special hedge accounting rules, the change in fair value of this instrument also will be recognized in P&L account 1300. If I don't account for this entry, then your P&L account will show a huge gain this year 1300. But next year, on 1st January next year, if you sell this asset, you will show a huge loss of 1300 in the beginning of next year. So this year gain and next year loss, but the effect is nullified. If it is different accounting year, it makes your P&L account volatile. So I have shifted the loss which I was going to recognize in the next period in this period only. Try one more question for practice purpose. Same problem, different data. A Limited has given a 10% fixed rate loan to S Limited. A Limited measures this loan at amortized cost of 2,50,000. A Limited plans to hive off the receivable at a later stage, and as a measure to safeguard against fall in value of its dues, enters into pay fixed, receive floating interest rate swap to convert the fixed interest receipt into floating interest receipt. A Limited designate the swap as a hedging instrument in a fair value hedge of the loan asset. Same problem. I am not explaining because it is same. Over the following months, market interest rate increases and A Limited earns rupees 25,000 on the loan. How did they get this 25,000? 10% of 2,50,000. In some exam, they don't give these numbers. They will just say past journal entries. They will give you this 1,000 figure, but they will not give you 25,000 because this you can calculate. The fair value of the loan asset decreased by 1,000 and fair value of interest rate swap increased by rupees 5,000. All conditions of hedge accounting are satisfied. Past journal entry in the books of A. What is the type of hedge mentioned in the problem itself? Fair value hedge. Is it right? So past same 4 entries. Interest received on loan asset, interest received on interest rate swap, gain on derivative, loss on loan asset. Check the answer. Over. Cash or bank account debit 25,000 to interest income 25,000 being interest income recorded on the loan. Cash or bank account debit 1,000 to interest income 1,000 being net interest settlement of the swap. Derivative account debit to hedging gain in bracket right P&L account 5,000 being gain in the fair value of derivative, and hedging loss account debit to loan account, this also write P&L account. So these two will go to P&L account and net effect will be 0. The only effect will be this differential amount which goes to P&L account extra. Okay. In classroom the figures are small like 5,200. You don't feel the impact. Practically these figures can be huge. In crores, in hundreds of crores. And therefore it will really change the shape of your P&L account. And that is why hedge accounting rules are designed. Okay. Now one more question. The first two questions were based on financial asset. Next question is based on a liability. And this time the student will have to calculate the difference. On 1st April 2007, A Limited borrowed rupees 10 lakh. Borrowed liability. Previous was given loan asset at annual interest rate of 7%, and this time one more change, payable half yearly, underline. So we will have to pass 8 entries now. 4 plus 4, 4 entries at the end of 6 months. Again 4 entries at the end of 12 months. Another 6 months. So what is their liability? 10 lakh loan and interest of 7% payable half yearly. The life of the loan is 4 years. But there is a problem with no prepayment permitted. Prepayment is not allowed. Once you have borrowed, keep paying 7% for the next 4 years. Okay. The company expected the interest rate to fall. But after taking the loan at fixed rate, now they are worried that interest rate may fall. And we are stuck with a high interest rate. And you can't prepay the loan. Still you want to pay lower interest rate. Can we achieve this? Yes. So on the same day, it entered into an interest rate swap arrangement. What is the arrangement now? Whereby the company would pay 6-month LIBOR because they expect that interest rate will fall. So they will pay at a variable rate, floating rate, so that if LIBOR falls, they will pay lower interest and would receive annual fixed rate of 7% every half year, and they will receive fixed. Fixed 7% received will be used to pay your original liability, and you will end up paying at a floating rate. You will end up paying at a floating rate. The swap effectively converted the company's fixed rate obligation into floating rate obligation. Falling value of swap and debt are available. Now this time they have given you the valuation of swap and valuation of debt. So in this subject they will give you the value, don't worry. Whatever is required they will give you, but what you can calculate, you have to do it. So what happened to fair value of this swap? Plus 0.2. From 0 it became plus 0.2 because the fair value of derivative is usually 0 unless you pay some premium on that. Okay. So gain of 0.2. What happened to the liability? 10 lakh became 10.2 fair value of liability. Tell me, gain or loss? Liability has increased. Gain or loss? Loss. But this loss is fully compensated by gain on derivative. Now what happened next 6 months? This is after 6 months. This is another after 6 months. Plus 0.2 became minus 0.1. So how much is the change in fair value? 0.3. Yes, so my fair value has changed by 0.3. It has decreased. So I will recognize a loss on derivative here. 0.3. At the same time, the liability, which was 10.2, fair value is now 9.9. Gain or loss? Gain, because the liability has reduced. Reduction in liability is a gain for the organization. Now, in order to calculate the floating rate interest, they have given 6-month LIBOR on 1st April 2007 was 6%. So 6% LIBOR, last 2 lines. So I will explain now. 2 periods are involved. We will pay floating XA Limited and we will receive fixed. Okay. What is our negotiation with this other party? That company will pay 6-month LIBOR. So I will pay in the first half 6% and I will receive fixed rate 7%. So am I a gainer or a loser in the first half? Gainer, because we will pay floating. Floating is equal to LIBOR and LIBOR is 6%. LIBOR is 6%. So 1% gain in the first 6 months. What happened in the next 6 months? We will pay floating and floating rate is equal to LIBOR, and the LIBOR in the next period has risen to 8%, but the other party will continue to pay us a fixed rate of 7%. So dear student, now we'll have a loss of 1%. Is it right? Think about it. First 6 months, we will pay 6%. We will receive 7%. As I have told you, in practice they don't pay or receive separately. Only the winner will get the difference. So I am the winner in the first 6 months, A Limited. I'll get 1% of 10 lakh for 6 months. All rates are per annum in the question. And in the second half, I have to pay 8%. I have to receive 7%. So I'll have to pay 1% difference on 10 lakh for 6 months. That's it. Change in fair value they have already given to you. Okay. So pass the entry. In the first 6 months, you will receive interest. Sorry, you will pay interest on original loan. Original loan is 10 lakh rupees. At what rate? 7%. Original loan is 10 lakh at 7%, but you are paying half yearly interest. So into 6 by 12. Interest account debit to bank. 35,000. Calculation 10 lakh into 7% into 6 by 12. 10 lakh into 7% into 6 by 12. Keep writing calculation. Otherwise, my mail account is flooded with such queries. Sir, why 35? Why not 70? Half yearly, dear. Loss on valuation of debt account debit 20,000. It is given. Now, what is the calculation for this? 10 lakh 20,000 minus 10 lakh. 10 lakh 20,000 minus 10 lakh. To loan account 20,000 being increase in the value of debt recognized. Next entry is swap hedge account debit 20,000, or you can just write down derivative account debit. Interest rate swap account debit. Okay. Any name you can give to this product. If you don't find any good name, just write derivative. To gain, in bracket write P&L account. And how this 20,000 has come? From 0 to 20,000. From 0 on day 1 when you enter into a IRS interest rate swap, the fair value is 0. At the end of 6 months it is given plus 0.2. Is it given plus 0.2? The plus 0.2 means gain of 20,000 rupees. We are writing in entire 5 digits, so 20,000. If you want to write in lakhs, write plus 0.20. And what about the interest differential you are going to receive? 5,000. How did you get this 5,000? 1% of 10 lakh into 6 by 12. 1% of 10 lakh into 6 by 12. If you write calculation, it is easy to revise. That is what I know. You don't have to struggle in the last minute. And these are typical questions in the exams. Okay. Next question. What will happen in the next 6 months now? I will pay interest every 6 months to my lender at 7%. Original liability continues. Interest account debit to bank 35,000. But now there is a gain on revaluation of debt. From 10.2, it is 9.9. So gain of 30,000. Entry. Loan account debit 30,000 to gain on valuation of debt 30,000 in bracket write P&L account. Gain on valuation of debt in bracket P&L account. And please write calculation also. 10 lakh 20,000 minus 9 lakh 90,000. 10 lakh 20,000 minus 9 lakh 90,000. Written. And then I will revalue my derivative product. Now here the student make a mistake in calculation. They think plus 0.2 and minus 0.1. So difference is 0.1. No. You are moving from plus 0.2 to minus 0.1. So I have to calculate the change. Change is 0.3. Is it right? Change is 0.3. From 20,000 positive It has become 10,000 negative. It's like I am asking you a question. You have 20,000 rupees balance in your bank account. You withdraw some money. After you withdraw, now the balance is overdraft 10,000. How much amount you have withdrawn? 30,000, not 10,000. So 30,000, 20,000 minus, again minus 10,000. Minus plus. And what about the interest? This time you will pay the interest. This time you will pay the interest. Interest account debit to bank. Write down calculation. 1% of 10 lakh. 1% is 8 and 7 ka difference. Difference of 8 and 7 into 6 by 12. Okay. Into 6 by 12 you written. These three examples were on fair value hedge, where we are protecting the fair value of either the asset in the first two example or liability in the current example. One more example will take on fair value hedge. Question number 58. Oh, solution is to be written in the notebook. Very good question. ASF Limited has rupee as its functional currency. It has chosen to treat all hedges of foreign currency risk associated with firm commitment as fair value hedges. Okay. So one thing is good. Fair value hedges mentioned. Even if it is not mentioned, for unrecognized firm commitment, we will follow fair value hedge. In January 2017, it contracts with the US supplier to purchase a machinery. Now, you are an Indian company, your currency is rupee, and you have entered into a contract with a US company to buy machinery. Machinery will be delivered in July 17, and the contracted price is $1,000. Since it is in dollar and the dollar rate is going to change, the value of this firm commitment is also going to change. Value of this firm commitment contract will also change. ASF Limited contracts with the bank to purchase USD 1,000 in July at a forward rate of 60 rupees per dollar. So to protect your risk, you have entered into a forward contract at 60 rupees. If the fair value of the forward contract at the end of 31st March 17 year end is rupees 3,000 positive to ASF, on delivery rupees 5,000 positive to ASF, spot exchange rate is rupees 65 per USD. Spot exchange rate in July is rupees 65 per USD. That is just I think duplication. Calculate past journal entries. Past journal entries. So you have two contracts in this problem. One is a firm contract to buy a machinery for $1,000, and one is a forward contract to buy $1,000. Forward contract will be net settled. Is it right? So what is the first entry you will pass on 1st January 2017? 1st January 2017, no entry. Okay. You have to practice a lot of questions. That is why I have taken many problems. With practice, you will be able to understand. Some knowledge of finance is also required for solving such questions. Some knowledge of accounting standard on foreign exchange rates, effect of change in foreign exchange rate is also required. So first note, write down nil, no entry because forward contract is nil, fair valued, and no cash is received or paid. And no cash is received or paid. Okay. Then what is the year ending date in this problem? 31st March. 31st March. what happened on 31st March? It says that the fair value of the forward contract at the end of 2017 is 3000 positive to ASF. So the value of this forward contract will increase from 0 to 3000. Pass the entry. Now this is a hedging instrument to hedge the risk of a unrecognized firm commitment, and where it will be transferred to P&L account. So write down forward contract account debit to P&L account. Forward contract account debit to profit and loss account 3000. Calculation is not required, given in the question. Narration right for understanding being increase in fair value of forward contract. Now here there is a hidden entry. You have a firm commitment to buy machinery for $1,000. So don't you think if there is a gain on forward contract, there would have been a loss on the firm commitment also? You can't have gain on both. Gain on this means there would have been a loss on the firm commitment. So you have to bring that also into books. Entry for loss on firm commitment contract. If exchange rate changes, if derivative is generating a gain, it means the underlying is generating the loss. Is it right? So same amount, loss entry. I had written the last adjustment, if you remember fair value age. The change in fair value of firm commitment will be recognized in P&L account. Change in fair value of derivative will be recognized in P&L account. And in case of effective hedge, gain in one is compensated by loss in another, or loss in one is compensated by gain in another. P&L account debit to firm commitment account. So the effect of these two entries, zero effect in P&L account. Zero effect in P&L account. Being recognition of fair value of unrecognized firm commitment in respect of change in forward exchange rates. Same two entries you repeat now on 30th June also. 30th June. What is the rate? July, 65 rupees per USD. And forward contract rate was 60 rupees per USD. So if you have a right to buy at 60 rupees per USD and market rate is 65, gain or loss? Gain. And they have mentioned also on delivery rupees 5,000 positive to ASF. How kind. So your fair value forward contract was 3,000 earlier. Now it is 5,000. So what is the change in fair value? 2,000. Total gain is 5,000. 3,000 I have already recognized. So in the next entry, I will recognize the increase in fair value of forward contract. Forward contract account debit 2,000 to P&L account 2,000. Okay. Being change in fair value recognized, which means the firm commitment will have 2,000 loss. You were supposed to buy a machinery at 60 rupees per dollar, but now the rate is 65. So you'll end up buying at a higher rate now. So there will be a loss on your firm commitment. You were supposed to buy machinery when the rate was 60, but when you ended up at 65. So there is a loss of 5,000. Out of that 3,000 I have already recognized in the earlier entry. So now I will recognize 2,000 loss. P&L account debit to firm commitment account 2000. So what I am doing, I am nullifying the impact in the P&L account. Now I am going to the market, and the other party with whom we have entered into forward contract, we will say now we want to settle our forward contract. Please pay me the difference. Please pay me the difference. So he will pay me how much? 5,000. It's a forward contract. We are the gainers. The rate has moved from 60 to 65. So we will earn 5 rupees difference into $1,000. Bank account debit to forward contract account, 5,000 being settlement of forward contract. In fact, they have given this number also in the problem. Which account closed now? Forward contract account closed. Now what I am going to do? I am going to buy the machinery. Machinery account debit 65,000. Because today the rate is 65. To bank account 65,000. But don't worry, your effective cost is 60,000 only. Because 5,000 rupees you have gained. But transactions will be done as follows. Forward contract will be net settled. Machine will be bought separately. Effectively, if I see my cost is 60,000. But the book value is 65. No, wait. I have one firm commitment account open right now. So I had written one last note. The balance in firm commitment account will be adjusted against the value of asset or liability recognized. So this firm commitment account has a balance of 5,000. Earlier 3,000, then 2,000. So that account you will close and adjust it against machinery account. So the next entry will be, anybody, next entry, firm commitment account debit to machinery account, amount 5,000. So effectively your machinery comes in the books at 60,000. No gain or loss is recognized in P&L account. Loss and gain both are equal. So this accounting simplifies your impact in P&L account. Is it right? Otherwise your P&L account could have been more volatile. Being removal of carrying amount of firm commitment and adjust the carrying amount of machine. This is exactly the application of theory. Standard only gives me the theory. If there is a firm commitment, change in fair value of firm commitment, P&L account, change in fair value of derivative P&L account, when the asset or liability is recognized, the carrying amount of firm commitment is adjusted against the asset or liability recognized. This is the theory. And this is what we have exactly given the effect of that. Question for another 8 marks. ASF Limited maintains an inventory of cocoa that it uses in production of chocolate. Wow. ASF wants to hedge the risk of price changes in the inventory of cocoa, and on 1/7/2005 it enters into a forward derivative instrument that is indexed to cocoa. The fair value of the inventory has decreased by rupees 50,000 and the fair value of the derivative has increased by 50,000. Pass journal entry to recognize the fair value hedge. So this time you don't have to pass so many entries. Only pass entry for change in fair value of the inventory, change in fair value of derivative. Both will be recognized in the P&L account in the same time period, because it's a fair value hedge. So write down first when they entered into this contract, 1st July. 1st July. What is the entry you will write? No entry. No entry because the fair value of forward contract is nil. 1st July Date write on 1st July. For how many months this contract was entered into? Is it mentioned? No. So don't write the date in the next entry. Just pass two more entries. One is forward contract account debit 50,000 to P&L account 50,000. Being increase in fair value of derivative recognized. Being increase in fair value of derivative recognized. And one more entry on the same date. What has happened to the fair value of inventory? Decreased. So entry will be P&L account debit to inventory account 50,000 being decrease in the fair value of inventory. Being decrease in the fair value of inventory. Both will go to P&L account in the same period. Okay. So that your effect is zero. Otherwise, this year you will recognize the gain. Next year, when you will sell the inventory, you will recognize the loss. So your profit will be higher in current year and lower in the next year. But effectively, as an organization, it is zero because the loss I have already hedged by using a derivative. So why don't you recognize both in the same period to have a minimum effect on the profit and loss? One more very important question, number 60, tick mark. 60. On 1st January 2010, ASF Limited issued rupees 200 million 5-year 9% fixed rate debt. Is it understandable? Interest on debt is payable annually. ASF interest rate risk policy requires that all debts are at variable rate. This can be achieved either through issuing variable rate debt or by issuing fixed rate debt and swapping it into variable. So what is the policy of this company? Use variable rate. Now how will you get variable rate? Either you directly issue a variable rate instrument or you borrow at fixed rate and swap with a variable rate. Therefore you convert variable rate liability into a fixed rate liability into a variable rate liability. To maintain compliance with this policy, it entered into interest rate swap to convert the debt from fixed to variable and designate the swap as underline fair value hedge. Because your answer will change if it is a cash flow hedge. So when the problem gives you a particular hedge, follow. The swap is a 5-year pay MIBOR. What is MIBOR? Mumbai Interbank Offer Rate. That is a rate of interest charged by one bank to another bank in Mumbai Interbank Market. Okay. So that is MIBOR. LIBOR, MIBOR. Okay. So in London. In different countries they have a similar names. In Pakistan, in Karachi market, they have Kaibor also. Karachi Interbank Offer Rate. Yes. But I will not write that. Kaibor I will not write. Sensitive issue. A swap is a 5-year pay. MIBOR receives 6.5% fixed rate swap. Have you understood the swap? What ASF will pay? MIBOR. What it will receive? 6.5% fixed rate swap. So this will effectively convert its fixed rate into floating rate. Is it right? ASF Limited satisfies the hedge accounting criteria. The fair value of the swap and the carrying amount of the debt. This similar question we solved just now. as adjusted for change in fair value attributable to hedge risk are as follows. On 1st January, we issued a debt of 200. On this date, the fair value of swap is 0, already given in the problem, nil, because there is no cash received or paid. Then you will pass this entry. The value of liability has increased by 5, so loss. Swap has increased from 0 to 5, gain. Then next 6 months, liability decreased from 205 to 201, gain. Fair value of swap decreased from 5 to 1, loss. So 4 gain, 4 loss. In the previous 6 months, 5 loss, 5 gain. It's effective hedge. So impact on P&L account should be 0. Pass journal entries to reflect the fair value hedge. One good news, ignore interest entry. So don't bother about interest received or interest paid. If it is not mentioned, then yes, you will have to do the calculation that we had done in one previous problem. So you have to pay interest on original loan, which is 9% fixed rate, and then you have to calculate the difference between interest paid and interest received, and only pass entry for net amount. That you cannot do calculation in this problem because the MIBOR is not given on 1st January and 30th June. So in any case, even if you want to pass entry for interest differential, you can't do it because the MIBOR rate is not given to you. Okay. So write down, this is an easy problem. Ignore the interest entries. Other than interest entries, you will have to write bank account debit to debt account 200. Being debt issued. What about the entry for swap on 1st January? Right below 1110, no entry for swap because fair value is nil. No entry for swap because fair value is nil, and no cash is received or paid, and no cash is received or paid because just you have entered into a contract on that day. No cash is received or paid, fair value is nil. Then we'll go to 30th June 10, read the question. The fair value of this swap, which was 0 at the beginning, has moved to 5. So swap account debit 5 to P&L account 5. Change in fair value of derivative will be recognized in P&L account. In case of fair value hedge, only one exception is there. If it is used for hedging an equity instrument which is designated as FVT OCI, then fair value of derivative goes to OCI. Otherwise, in fair value hedge, except that situation, all change in derivative will go to profit and loss account. Now pass one more entry for change in the fair value of the debt from 200 to 205. You have to pass. Come on, try. P&L account debit to debt account 5. It was easy. Okay. Being increase in fair value of debt. Being increase in fair value of debt. And then you write in the next 6 months, the swap value has gone down from 5 to 1. Always pass the entry for change. Always pass the entry for the change. What it was last time, what it is now. 5 minus 1, 4. 5 minus 1, 4. So this time there is a loss on derivative. P&L account debit 4 to swap account 4. But this time there is a gain on the debt instrument. From 205 it has become 201. Is it right? Entry. Debt account debit to P&L account 4 being decrease in fair value of debt. So what is the effect in the P&L account? 0. If you don't follow this hedge accounting rule, and if you value the debt at amortized cost only, like you normally do, then you will have losses getting recognized in P&L account. Now, okay, and then in future, whenever you will de-recognize the liability, then gain will get recognized, or vice versa. One more question. During year 1, an investor purchases a fixed rate debt security for rupees 10 million. Based on IFRS 9 principle, it is classified as FVT OCI. All previous problem that you have discussed was amortized cost instrument. Is it right? So now let us take FVT OCI. So this is a debt instrument measured at FVT OCI. At the end of the year 1, the fair value of the asset is rupees 11 million. Gain or loss? Gain. From 10 million to 11 million, there is a gain. It's an asset. It's an asset. And you normally, what normally you will do? You will credit that 1 million gain to OCI normally. To protect this value, the investor enters into hedge by acquiring a derivative with nil fair value by the end of year 2. So first year, the derivative has a fair value of 0.5 million and debt security has a corresponding decline in fair value. Past journal entry. But there is a small question you have to answer. When did we enter into a derivative contract? Was it at the beginning of year 1 or was it at the end of year 1? At the end of year 1. It means till in first year there was no derivative used. Till 1 year there was no derivative used. So till first year this instrument will be accounted like a normal FVT OCI. But from second year now this instrument is hedged using a hedging instrument, and assuming it's given also no assumption, past journal entry for fair value hedge. So then next year the change in the debt security will be routed through P&L account. First year OCI, because first year there is no hedging. So can you write the entry? Okay, first we will make investment. Start from 0. Go till the end of year 2. Okay. Write down year 1 beginning. Year 1 beginning. In bracket write beginning. Investment in FVT OCI debt instrument account debit 10 to bank account 10. Then we will go to end of the year when the fair value was 11. Year 1 end, write down investment in FVT OCI debt instrument account debit to OCI account 11 minus 10. Remember in this question the hedging was started not from beginning of year 1. So first year our usual entries, what we learned in the last 3-4 days, to OCI account. But then you hedged it in the next year, second year, and you want to follow fair value hedge accounting. So in the second year, at the beginning we took one derivative. What about the entry? No entry. Okay, so year 2 beginning, right? No entry for derivative. No entry for derivative as the fair value is nil. No entry for derivative as the fair value is nil. And no cash is received or paid. Now go to end of the year. End of the year, this instrument is an OCI instrument. In a usual circumstance, you would have transferred that difference of 0.5 million to OCI account. But this time you will not do that. This time you will not do that. This time you will transfer the difference in the debt security to P&L account and the change in derivative also to P&L account. So dear student, write down year to end. Exact date is not given. Derivative account debit 0.5 to P&L account 0.5. Is it written there? By the end of year 2, the derivative has a fair value of 0.5 million and the debt security has a corresponding decline in the fair value. Now here you have to be very careful. Even though it is an OCI instrument, but it is a hedge item under hedge accounting rule, the change in fair value will be transferred to P&L account, so that P&L account will have zero effect. 0.5 gain, 0.5 loss. P&L account debit 0.5 to investment in FVT OCI debt security 0.5. Now suppose in this question, instead of debt security, it was mentioned equity security. So then both P&L account will become OCI. Keep that much in mind. So as a homework, you solve the same problem. Assuming it is an equity instrument, so these two entries will become OCI. First year is already OCI, no problem. First year is already we have transferred to OCI. Second year also, equity as well as derivative, change in fair value of both will go to OCI. So I'm not writing that question, but please try as homework what entries you will pass if this instrument was an FVT OCI equity instrument. Yes or no? Only these two entries will change here. Both will go to OCI. Okay, now we'll continue on Monday.